only 30 minutes, isn't
It depends on how fast your clock is moving. Order, hear that, Tom? Meeting to order.
Order.
Oh, we got our chair, Randall, with us too as well.
Yes.
And he looks like he's got a different background, hiding his location. He's probably partying at the beach, and he just doesn't want any of us to be envious.
That is an invitation for me to say no comment.
You'll take the fifth.
Okay, well, I think some others may kind of trickle in. So if Patrice or Courtney are kind of managing the background, they can let them in. I see Wesley has joined us as well. So Courtney, do I turn it over to you or do I turn it over to Mike?
Well, let's turn it over to Patrice first, and she will call the roll.
Okay, good afternoon. I'm going to start with the Finance Committee. Chairman Chris Parker.
Present.
Commissioner Tom Griffin.
Here.
Commissioner Hugh Jernigan.
Here.
And Commissioner Younger will not be joining us. And then Chairman Randall Tuttle.
Here.
Commissioner Hal Day. Commissioner Wesley Curtis.
Present.
Commissioner Dwayne Long.
Here.
Commissioner Yvonne Hines. Commissioner Donald Stewart. And Commissioner Charles Wilson.
Present.
Okay, thank you.
Okay, thank you,
So, sorry, Chairman Parker. Well, I'll go ahead and just kick us off here. So today we're presenting our operating budget and our rate recommendations for both water, sewer, and solid waste. And before we get started, I know I sent out an email last week, but I did want, in case you missed it, just to recognize that our utility was ranked like number 2 in the country amongst the top 200 largest cities for best quality water. So that is something to really be proud of. And we do have a really great staff, and we do have a great board that provides us the support that we need to do our jobs effectively. So I do really appreciate that. So with that, let me announce who's on our call here. Most of you can see we've got Damon Duquesne, Assistant City Manager, Patrice Glenn, Senior Administrative Assistant, Mike Quavisto, Deputy Director, Jan McHarg, Assistant Director, Solid Waste. Ricky Rubio is our budget analyst, and he helps prepare the budget. I know a lot of y'all don't see him on a regular basis, but he is really involved with our budget process. Kyra Boyd with the communications team, Lisa Saunders, Chief Financial Officer, Kelly Latham, Deputy Financial Officer, and I don't think she's joined yet, but Heather Curie with our budget office was going to join, so maybe she'll join us shortly. And with that, Mike, I'm going to go ahead and turn it over to you. Do you want me to go ahead and share the slides?
That would be great. Thank you, Courtney.
Share my screen.
All right. Thank you, Courtney. As Courtney mentioned, we are, and good afternoon, commission members, I may add. Here's our agenda for today, this is typically, for many of you, I think our most fun meeting of each year. So I want to welcome you once again to our operating budget discussion. We'll start with a budget refresher, and then talk about the water and wastewater budget. Then Jan McHarg will go through the solid waste budget request, and then we'll talk about the next steps at the end and some along the way as well. So our budget refresher, the city has a general fund, which is funded through property taxes, state and local sales tax, and consists of departments such as police, fire, recreation, transportation, sanitation, Human Resources, the City Council sets the property tax rate for the city, and the Forsyth County Board of Commissioners sets the tax rate for Forsyth County. The property tax rates, those are. And then we are an enterprise fund, and we are funded through both the water and wastewater and solid waste. We have our own funds. They're both enterprise funds, and they're funded through charges for service. On the water side, that's consumption and readiness to serve primarily, and then on solid waste, it's the vast majority of that is tipping fees. So looking at the current year budget and the components that make up our water and sewer revenue budget, you can see that the majority of our revenues are from our water and sewer charges. And then on the solid waste side, you can see that the $13.6 million revenue budget is made up of mostly tipping fees. And then on the expenditure side, for water and sewer, our budget was $92 million for FY21. And the biggest piece of the pie there is for our debt service payments. And then on the solid waste side, the $11.5 million, their largest piece is for supplies and services. So that's just a little primer on the overall budget picture for the current year. We'll get into the details of each of these pieces for FY22 starting right now. So we did want to kind of give a little bit of a refresher as to what happened last year while we were going through the budget process. We did reduce over $500,000 in budget requests for FY21. A lot of that was in the contracted service area, which will see a larger increase as we go through our FY22 request. We did not recommend a rate increase for FY21 due to the unknowns with the pandemic. Given that, we're anticipating that we need a rate increase for FY22, and our intent is to keep that as moderate as possible. We did defer a number of capital outlay requests. There were 13 pieces of equipment that were requested by our divisions that we did not fund last year, or for the current year, I'm sorry, FY21. And then we talked about our capital budget last month, and we have delayed and reduced the scope of some of those capital projects to try to mitigate impacts of the pandemic as best we could. So what does our FY22 budget request look like on the water and sewer side? The total expenditures are at $98.8 million, which is a 6.59% increase. If you look to the right there, of the circle, the debt service is going up 10.32%. That's the big driver for the total increase to the 98.8. Debt service is increasing $4.3 million, and which is in anticipation of a new revenue bond issuance in FY22. Our operating budget, which is our personnel and supplies and services, the two kind of square bubbles on the left, that's going up about $1.8 million combined, and a total of 3.58%. We'll talk a little bit about what makes up those pieces here as well. Any questions here? All right, personnel, on the personnel side, the total is $23.9 million for our request for FY22. It's going up just under $700,000. It does include an average 2% merit increase and 2 new positions, an assistant city attorney and an assistant water treatment plant supervisor. That's all reflected in the full-time salaries there, going up 3.43%. We also have a slight increase in overtime of just under 3%, and benefits are going up just under 2%, which the big driver there is contributions to the state retirement system for our employees.
Mike,
Questions there?
You're going to talk about these later in some detail.
Which ones, Mr. Griffin? Sorry.
Well, full-time salaries, for example, you got 2 new positions. You're going to talk about that?
Yes, sir.
Okay.
Yeah, well, and we can actually talk about it right now. We've and we have had, obviously we get support from the city attorney's office, significant support from the city attorney's office, but given the large number of contracts that we have to handle and the level of detail there, and then also all the interlocal agreements that we work through, and all of the constantly changing regulation environment, we have worked with the city attorney's office, the city manager's office, and the human resources department, and to justify the need for our own assistant city attorney to help us, to basically work for us full time and be an advocate for us on the regulatory side, and to have the continual support we need on the contracts, and the interlocal agreements. And then for the assistant water treatment plant supervisor, we have an assistant wastewater treatment plant supervisor, and from basically a succession planning and having a number two in charge, we're looking to add that for Bill Brewer, to have someone who can help him in that role. So those are the two new positions and the needs for them.
Mike, this is Dwayne. A question regarding, we now have a full-time attorney when this budget comes through, but are we reducing then the cost transfers that we make to the city for use of their attorney that we've long been doing?
So that would be the intent. We would anticipate that those charges would ultimately decrease for us, but even though we will have our own assistant city attorney, and also let me mention that position will report to the city attorney from a reporting structure, but basically work through Courtney to facilitate what we're looking to get out of that, what we need out of that position. So we'll still need support from the city attorney's office for specialized services related to real estate or information systems contracts or those types of things. But we would anticipate a reduction in those charges over time.
Okay.
Hey, Mike, it's Chris. Is Heather Curry on the line with us?
I am.
She is.
Okay, so that question the commissioner just asked, when do you look at that cost allocation? When would we be able to see some type of change in that based on our proposal here to add a city attorney?
So the cost allocation plan uses the last audited financial statement. And that process usually starts in the fall. So that we'll be redoing the cost allocation plan with our consultants starting this coming fall. And so the financial statement that will have been audited at that point will still be FY20. So it's a couple years behind. So it will not decrease right away, but it would over time.
From that, so to use an example of a previous position, we had Gail Kettler, who we hired to do PR full time. How long did it take for us to see an adjustment in the indirect cost allocation for that position?
So the cost allocation, I'd have to actually go into the plans and pull numbers and look at marketing specifically to answer that directly. But in general, it runs about 2 years behind.
Okay. So, Dwayne, does that answer your question?
Well, it kind of does. If I'm hearing this right, we're doubling up for a couple of years on this by adding the position, which there may not be a way around it.
Well, and I will note that, yeah, it may seem like we're doubling up, but right now we have so much work that needs to be done that's not getting done. I mean, it's just, I wouldn't say it's not getting done. It's just we have a lot of new regulations, a lot of contracts, and so the time it takes and the amount of review that we need, we really do need that extra time. So I see what you're saying about doubling up, but it's a service that that we just really need more time allocated.
Do we need both the city's department and this attorney to get done what we have to get, what we need to get done? In other words, is there enough work for both parties, the city's attorneys and this new hire, to stay busy on our stuff as they have? Yeah,
so the attorney that we would hire that would be, focused just on utility work, it would be a full-time job. We will still need the city attorney's services. So Angela Carmen, who's the city attorney, all kind of final decisions go through her. So we'd still need her as as kind of the end-all kind of decision maker as far as the legal side goes. But the services that we would need directly from the city attorney's office would go down in essence every year. We'd still need some, but not to the degree that we do right now.
Okay, I've got an answer. Thank you.
Okay, any other questions on the personnel slide here? Okay, move on to look at the supplies and services side of things. So this graph shows the recent history of our supplies and services budget. The blue line is the annual budgeted amount, and our spending is in the green shaded area. And as you can see, we've skirted our budget several years in the past. We're currently anticipating to come in about $700,000 under budget as of right now for FY21. We do often spend additional funds towards the end of the year, so we may end up closer than that 700,000. But we are currently running at about 45 vacancies on the water and sewer side, which is our highest in a while, maybe 5 years or so, and then 33 of those are at field operations, which is also the highest in 5 years. So that is, when we have vacancies, we don't buy as many supplies. We're unable to get quite as much work done. So that's part of why we're under our budget there on the supplies and services side currently. So what are we looking to request for FY22? It's about a $1.1 million increase, or 4.19%, with a significant portion of that being the contractual services. This was the primary area where we did defer requests from FY21. Excuse me, and this does include an increase in our paving contract. There continues to be a high number of repairs for street, sidewalk, and curb cuts related to the work that we're doing throughout the system. It's also got the first year of the Muddy Creek power generation. Oh, sorry, Courtney. Don't, hold on. I've got some more contracted services to talk about. The first year of the Muddy Creek power generation equipment service contract, a technical support contract, and credit card fees do continue to increase due to the number of payments that are being made via credit card, and then the amount of those payments, and then the rates that we're being charged for those as well. Moving on to our indirect cost allocation, which Mr. Long was just referencing. The indirect cost allocation is what we pay for city services that are not charged directly to our budget for departments such as city manager, human resources, financial services, city attorney. This is going up about 4.6%. And for reference, in FY21, it actually went down $9,000. So for rent and utilities, we've got an increase of about $120,000. We'll have a larger space across the street in the Stewart building, and we'll be paying more for that space. We're also seeing an increase in natural gas costs. For buildings and grounds maintenance, we've got an increase for contracted custodial services, mowing services, and then support from the city's properties and facilities management division. Risk management, we are seeing an increase in insurance, an anticipated increase in insurance costs based on the current market for property insurance, and we'll know more about that. They've got an RFP out on the street. for that. We've got an increase in charges from the city's information systems department. They're implementing a couple of new systems that will impact our operation. So that's what we're seeing with those increases. And then we've got other supplies and services going up about $32,000. But this number does include increases for the first year of software licensing for the WaterSmart customer portal, the Census AMI software, some increases for chemicals, electrical service costs, and then a lot of these increases are partially offset by a $250,000 reduction for deferred meter purchase costs, since they're currently being purchased out of our advanced metering infrastructure project. So once again, a total of a 4.19% increase for supplies and services.
And
looking at our transfers.
Mike,
yes,
this is Chris Parker. I'm going to say I do have some maybe more detailed questions about the indirect cost allocation, but in the interest of time, what I would just ask is maybe if I could sit down with you or Heather and maybe go over that in a little bit more detail.
Yes, sir. We'd be happy to do that. Okay.
Mike, it's Tom.
Yes, yes, Mr. Griffin.
I guess the question for Chris is, Chris, is your question going to have any impact on the amount of money you're talking about that's budgeted for indirect transfer? If it does, would we not need to be involved in that discussion also?
Well, the reason I said in the interest of time is based on what Heather had said, that this numbers come up, basically in 2 years. Okay. So I'm not sure that in this budget cycle right now that any conversation that we can have is going to affect this current budget. And if I'm wrong on that, somebody please correct me.
Okay.
You're correct, Chairman Parker.
That's correct. Thank you, Damon. Okay, sorry. So moving on to our transfers to other funds. We have we budget a transfer to the solid waste fund for household hazardous waste. That's going down slightly there. As you can see, 1.88%. And then our transfer to the general fund for a safety position and rodent control in the sewers is remaining the same for FY22. Moving on to
who handles that rodent control, Mike?
It typically goes through community development. When there's an issue, they reach out to us, and we help facilitate that through our field operations.
So why would we transfer them money if we're doing the work?
Well, typically we'll go out and look to see what needs to happen, and we end up helping support the remediation.
I can give you some more information on that, Mr. Griffin. So it'll be reported to us. We'll go out and investigate it. But as far as either baiting the sewers or whatever other type of vector control needs to be done, that's done through contracts through community development. So we don't hold those contracts as a utility. They do vector control for other reasons. And so we may go out and investigate just to see the scope of it. But ultimately, the remedy comes through a contractor that they hire.
Well, I know at one time, the vector control was in utilities, so it's just been moved out to community development. Okay.
Yes, sir.
Thank you again, Damon. Okay, looking at our debt service, as we mentioned, it's going up 10.32%. The large driver there is an anticipated revenue bond issuance in FY22. The state loan payments are decreasing slightly. And then our equipment lease payments are of $1.3 million are holding steady, even though we are replacing 19 pieces of equipment, or requesting to replace 19 pieces of equipment for FY22. And that's on the next slide here, Courtney. So we do have 11 requested replacements for field operations and 8 for wastewater treatment, for a total of $1.2 million. You can see the 1/5 payment cost there, and then also the interest cost associated with those replacements.
So the interest cost on almost $500,000 at wastewater treatment plant is $25,000. So what is that, 5% roughly?
It's 5.5%, Mr. Griffin.
Yes.
5.5%. So now this is coming out of municipal leasing. Is that correct?
Correct.
Correct. It's through the North Carolina Municipal Leasing Program that the city has. Yeah. Yes, sir.
So the interest rate, Lisa, I guess, is 5.5%. Is that looked at periodically, or I mean, it seems awful high with the marketplace right now?
Sure. Good afternoon, commissioners. This is Lisa Saunders. That 5.5% has been that way since the beginning of time. Some years, you know, the market would say it's more. Some years the market would say it's less. So the way the program works is every 59 months I borrow money. So the last time I borrowed money was 2019. I borrowed $25 million at 1.6% interest and put that in the fund. And then as the city has equipment purchases needed, we purchase it out of those proceeds, and the payments that come back in, we make the debt payment. So the program was set up so that general fund would not pay any interest on any purchases, and proprietary funds would pay 5.5. You know, we built fund balance over time in those funds. We've paid for systems at times with that extra fund balance that's benefited the utility. So, you know, it's a city program.
So, excuse me, go ahead.
No, you're fine. Go ahead. You ask your question.
I just, if I understand what you said, I didn't realize this, that the general fund doesn't pay any interest on any equipment they buy out of municipal leasing.
That is correct.
Everybody else that's buying equipment pays 5.5.
That's correct.
And it's never been adjusted. It's
never been adjusted. No.
So is any of the money in the fund used for any purpose other than buying equipment?
No.
Okay. So there's no history probably to tell us if, like you borrowed the $25 million at 2% roughly.
Right.
And so fund balance would be going up as far as we're concerned from our standpoint. But I didn't realize that was set up that way many, many years ago, that the general fund didn't pay anything. I thought everybody paid the same thing.
No, they don't. And so the investment income that we earn off the proceeds and the interest that the proprietary funds, for example, you know, water and sewer, solid waste, stormwater, fairgrounds, all these funds pay interest. Right. And so we make the debt payment back to the borrower from those payments.
Okay.
Okay.
So to kind of continue on with Mr. Griffin, so if we decided we wanted to seek funding outside of this, is that an option for utilities?
You would have to go through me to do that. And I could seek funding, but it would depend on how much you wanted to borrow, whether we would need to go through the local government commission or not. So it may not be the most efficient way of borrowing. But
what about PAYGO money?
That would be up to the commission whether they wanted to use PAYGO money.
Okay. And I'm going to throw out just another thought on this. What if when we put it out to bid that we asked for a bid from whoever's providing us with the equipment, of what they would charge for leasing?
We don't, Chairman Parker, we don't bid it by equipment. We get a loan from the leasing through the leasing corporation to purchase equipment for the entire city.
Well, so maybe explain this to me.
I don't think it would be advantageous if, for example, if you're asking me if I would go borrow $1.2 million for those pieces of equipment today solely for utilities, that's a different cost of funds probably that I can borrow for the city. We'd have to look at a different mechanism.
Okay.
Chairman, go ahead, sir. I think I know what you're asking. So you're saying when we take those specific pieces of equipment out for purchase and we bid, pickup trucks, or I'm going to leave specialized equipment out of the picture for a moment. Could you include as part of the bid, a 5-year payback at X% interest? You could. The problem with doing that, especially for vehicles, or I think a challenge that we would face if you want to take that approach is buying vehicles of these types. We get a better price when we can use, large volumes of vehicles. So I think if we tried to pare it out and do a 5-year payback at a specified interest rate, you may pay a little more for the vehicle, which could potentially wipe that out, and it would certainly take a longer time to get those replacements in.
Okay, so it sounds like if we wanted to have a discussion about this, it would be a discussion about whether we wanted to use PAYGO money and not pay any interest, just use the PAYGO we have, or whether we wanted to continue to use this North Carolina Municipal Leasing Fund at 5.5%. Is that what I'm understanding?
I think that's what staff would recommend. That would be the discussion to have if the commission wanted to consider that.
Okay, well, I'd say in the interest of time, maybe if I could challenge the staff to look into this, because as we make this analysis, I want to make sure there's no other snakes out in the grass or something that has an impact on just a straight decision versus PAYGO versus using these funds. Does that sound reasonable to the committee members?
Yes, it does to me. Damon, it's Tom. A question, go back to the bidding thing. Mm-hmm. Why couldn't we bid it and have, like we do a lot of things where we give people an option, and if they wanted to submit a bid with a 5-year pay plan, and it turns out it's at 1% interest, for example, and we're paying apparently 5.5% to go to municipal leasing. Is there a problem with choosing that avenue to buy a special piece of equipment? I'm not talking about where you want to buy 10 trucks and they're all just alike and general fund's got half and we've got half. I understand the need to try to have some uniformity in terms of how you do that. But when we're buying some of this crazy mess that we buy, I'm wondering if we ought to at least have an option in the bid package that they can offer us a deal.
Yeah, Commissioner, I think that's absolutely reasonable. I know we've had some success using like the Sheriff's Association to buy some specialized equipment. In particular, like our large jet vac trucks, because they get specialized pricing. But that's certainly something that we could balance what those prices are versus a bid with a 5-year payback and what type of interest. I think what the chairman and what you were proposing is doable for specialized equipment, but for general vehicles, I think you agree that, when you're buying 25 vehicles citywide that are similar, to break those out wouldn't be the most expeditious or prudent thing to do.
Understood.
I will add one thing, and that is if the commission were to decide not to use the North Carolina Municipal Leasing Program in purchasing their equipment, I need to know that during this budget cycle, because I'm going to borrow money in about 3 months that's going to include enough to cover these vehicles, and I won't have payments to pay the debt back if I do that, and there's a different direction decided. So just keep that in mind.
Okay.
Thank you.
Mm-hmm.
So, Chris, I think you all talked about this. My suggestion when staff looks at this is just to look at all the ramifications. I think you called them snakes in the grass, but just make sure we understand everything, the pros and the cons of this approach. Sort of why isn't the interest rate reset, but also on one side, but also are we getting a better interest rate but a worse purchase price? So what's the like I said, what are all the facts, and that'll help the finance committee make their decision, I think.
Thank you.
And to both the chair's points, there are some considerations as far as PAYGO is concerned in general as well that staff will bring forward for your consideration also.
Okay, thank you for the lively discussion on that. Okay, Mike, back to you. And let me just say, if I could mention to this, I mean, I think part of this process is us driving Mike Avista crazy by asking questions. But Charles, since you're one of the newer members, if you do have any questions, feel free, Commissioner Charles, to kind of let that be known and share those questions, because Mike loves to answer questions.
Okay, sure, I will.
That is true, and I also like to deflect them to the city manager's office. Okay, so circling back, here we're just looking at a summarized slide with the expenditure request. Once again, our personnel and supplies and services, which we consider our operating budget, is going up a combined 3.58% or $1.8 million. And as you can see, the debt service is really the big driver here for our overall 6.59% increase on the expenditure side. We'll move on to the revenue side of things. And as you all have seen in our monthly updates, our revenues for FY21 continue to significantly outpace the budget and last year's actual revenue as well. So our proposed revenues for FY22 are based on where we think we'll be at the year end for FY21, which is right in that middle column. Yes. Oh, sorry. Did someone say something? Sorry. Okay, sorry. The middle column there has our projected revenue for FY21, which is right at $120 million. And then, so for FY22, we're looking for an overall kind of 3% revenue increase. And so we think using the 6-year average for consumption and a rate increase that we'll show you the recommendation for here shortly will get us to that 123, 740, 720 number for the FY22 budget. And just to note that we are adding back in a budget for late fee revenues in FY22 as they were waived for part of fiscal years 20 and 21 due to the governor's executive order. And we did not budget anything for 21 at all, not knowing whether or not we would be able to collect those, reinstitute collection of late fees in FY21. Looking at our capital reserve contributions for the actuals for FY19-20, that first column there, our investment income really helped us get close to our budgeted revenues in FY20 and allowed us to add about $32 million to our capital reserve, which is in line with the amount of what we're trying to use to pay for our cash for some of our capital projects. You can see the next column there is the adopted 21 budget, where we were looking to come in just under $20 million, and now our estimated end of the year is just under $30 million. So that looks good. And then for our proposed FY22, we're looking at just under $25 million with our expenditure and revenue budgets.
Mike, when do we usually get our investment income figures in?
Lisa, do you want to, is that?
Yeah, sorry, I was trying to unmute. Chairman Parker, we post investment income numbers on a monthly basis. The numbers that are in today are as of March 31st. We've got about $11 million in investment income for water and sewer.
So if we could go back to that previous slide. So where am I seeing that? 11 million?
Currently, we're not showing that, Mr. Parker, because we don't know. We don't know where we're going to end up for the year end. We don't budget investment income typically, and so we're not actually showing anything for what we had for our adopted budget for 21, our estimated year end, or our proposed budget for FY22.
Okay, so at this point, I see your cursor there. Those two columns, adopted and estimated. Right now it's 11 million, but we don't know what the market holds for the next couple of months.
Correct. That's correct.
Thank you.
Okay.
Okay. With that, yeah, I'll turn it over to Lisa for some information on our water and sewer financial model. Thanks, Lisa.
Thank you. And good afternoon again, Chairman Parker and commission members. So a lot of this is just a reminder so we maintain and finance a comprehensive financial model that's used to forecast operating revenues, expenditures, financings, and our revenue bond coverage. Investment income remains in the water and sewer fund, and it's available to pay the debt and capital improvements. Our city financial policy guidelines require that we keep not less than 100% of operating and debt service. We've got a slide later that'll demonstrate this in cash. Cash and investments at the end of the year were $126,596,901 at the end of our fiscal year, that is June 30, 2020, which included bond proceeds of $10,310,496, and that was left over from 2017. We've not issued revenue bonds since 2017. I think our state loans that we've gotten has enabled us just to stretch that out a little bit to when we actually need to go to bond market again. Next slide, please. So our current cash flow projection, I am projecting that we would need to issue revenue bonds in the fall. We've been just kind of watching the cash spending for this year. I'd originally thought we would need to go to market now in spring of 21, but I'm thinking it'll be early fall, anywhere between 50 and 60 million based on the current spend plan that I've gotten from the staff. Our current state loans are 171 million. As you know, we've got another 20 that's been offered to us from DEQ that will go to the LGC to be approved in May. And then once that's approved, we'll bring it back to the commission and city council for approval. And then if you recall, last month, we actually applied for another 40 million in revolving state loans for Nielsen. Our goal has been for the last several years to use pay-as-you-go or use cash of 30 million for our capital spending. Our revenue bond documents require that we have a debt coverage ratio of 1.1 times. That means what we have left in after revenues and expenditures, that should be 1.1 times of our debt service annual payments. And the rating agencies would prefer that it be more than 2 for a highly rated utility as we are. And while I say that, let me update you on this because this has happened probably since the last commission. Periodically, the rating agencies, they do come in and they look at the utility on an annual basis, even though you haven't issued debt. And we've had Fitch and Moody's come in since the first of the year and review water and sewer, and they've affirmed the rates on both of them. So I thought that was very good. Next slide, please.
And Lisa, if I could just interrupt one moment.
Sure.
Could you maybe tell us what those ratings are as you say? So.
Sure. So we're rated AAA highest by Standard & Poor's. We're one notch below on Moody's and Fitch, which would be AA1 and AA+. So we're very comparable to all the other larger utilities in North Carolina. So we are very highly rated.
And when is the last time that's changed?
We got it's not since my tenure, Chairman Parker, so it has been a long time. Standard & Poor's came in and notched it up to AAA on their side sometime back in the 2000s. I'm not exactly sure, but they've been stable at that level for a long time.
So even though we haven't been at the 2.0, we've still had some of the strongest ratings.
We do have strong in rating. You know, one of the things they look at, well, they look at a lot of things. They're factors, many factors other than debt coverage. Liquidity is actually very strong. We have good cash reserves, and they give us extra credit for that, basically. Our ample water supply gives us good marks. They look at the management, the senior management of the utility. It's been stable. Consistent. They look at that. So there are many factors that go into it, but we are a very physically sound utility.
Okay, thank you for that explanation.
You're welcome. So the next graph is the water and sewer debt payments, and the purple at the top is the new debt. So concentrate more first on the light blue and the red. You can see in 21 we're right at $40 million in total debt payments, but I want to remind you that 2 years ago, or even last year, we were closer to 50 million. We had a high year, plus we refinanced a lot of our debt, so we brought it down. And then the 23 year in red that goes up, that's with the anticipation of the new revenue bond financing that we would issue of 50 to 60 million. And then of course the purple future at the red, not the other, the red, it's the state loans. Another thing to note is even though the state loans are cheaper, their payback is 20 years versus 30 years. So it does increase our annual debt service payment, but of course it's, it's better for us because it's a lower cost of interest. Okay. This was the graph I wanted to tell you about. So the middle line is what our financial policy says, and we always want to keep 1 times our operating and debt service expenditures in cash. And you see above it, based on my projection, what the cash could be. You know, every year is different. I have in my cash flow projection now between 3 and 5% rate increases over the life annually of this. Those are modest, I think. There has been a time that I did these cash flows at 8 to 10% increases. So just put that in perspective of what we're looking at here. So I think it's a very reasonable expectation. The bottom line is our revenue bonded debt. We're at $374,520,000. We get a little bump up. I actually showed the financing in 21 on here, so that's why you see it bumped up, not knowing whether it was really going to be 21 or 22. But then you can see it, streaming back down. And it looks like, well, I'll show you that in a minute. I was going to say something else, but let's go to the next slide.
Actually, Lisa, I just want to stay here for 1 second if you could go back.
Yes.
So are we saying that that middle line in 21 or 22, let's say we're going to spend $99 million just servicing our debt?
And operations. It's
and operations.
And debt. Yes. It's our total expenditure budget, basically.
I get it. Okay. Now it makes much more sense, right?
Yes,
okay.
yes, it is. It's our total expenditure budget.
Oh, and Lisa, could you maybe tell me what is the range on the interest we're paying on these bonds?
Yes, I can. Let me look at my sheet right here. The coupons on their bonds are anywhere from less than 1% to some of the older bonds that we can't refinance are 5%, but they're 0 to 3. Every time, when we have the opportunity to refinance, which we usually have callable 10-year bonds, we'll look at refinancing. And every refinance that we've done, we've had historically low true interest cost when you look at the whole deal itself in the 2% range. So.
Okay. Thank you.
You're welcome. Okay, so this, in contrast to what you saw earlier, you saw an appropriations chart earlier. This is truly what staff thinks we're going to spend on an annual basis. So for example, in 2021, we think we're actually going to write checks of $52,055,000. And then so I go into the funding section and I determine how we're going to fund all of these projects. So the first line is revenue bonds. If you remember, I had 10 million left over last year that I actually drew down in 21. And if you add 58 to that, that's where the 68 million in revenue bonds comes in. State revolving loan, that's just in 21, that's sort of funding all the old projects that are still outstanding, drawing down based on expenditures. Because if you remember too, you know, when you do a revenue bond issue, you get all the cash and we hold the proceeds and pay for projects out of the proceeds. But the state revolving loan is like a draw program. So we have a line and we don't actually get reimbursed and we don't incur the debt until we actually draw the money down. So that's why, you know, in 21, you see sort of an odd amount. It's just based on the spending of those projects. And then the next 4 years, that's totally Nielsen. That's the 120 million to pay for Nielsen. And then you'll see the pay-go is around 30 until the later years when we actually don't anticipate needing to spend quite that much pay-go. So over that period of time, we're looking at spending 388 million. 49% of it's pay-go. That's another thing that the rating agencies look at, and that's really good, that we're basically paying for half of these projects and only financing half of it. And that was it. I'll answer any questions.
Thank you, Lisa.
Thank you.
Yes, thank you, Lisa. So we'll move on to the rate, talk about our rate recommendation and our rate setting process. So what do we take into account while we're doing our rate setting? And much of this coincides with what Lisa just touched on. We want to generate sufficient revenues to fund our operating budget, our debt service, meet our coverage ratios, and maintain appropriate fund balances, while also protecting our bond ratings, recovering revenues based on cost of service, and being able to meet the long-term capital needs of the system. So our rates are made up of two primary components: the readiness to serve charge, which is also known as a base or fixed charge. It's the component of the bill that is determined by the size of the meter and helps recover the utility's fixed costs for things such as meter reading, billing, customer service, treating and delivering water, collecting and treating wastewater, as well as debt service and other capital-related costs. Then there's the volumetric charge component of the bill that recovers costs based on the volume of service delivered, and we currently have 4 volumetric tiers. So we've done 2 cost of service studies in the recent past, one in FY14 and one in FY18. And a cost of service study is done to determine if the rates accurately reflect the various service components, or costs being attributed to various rate classes appropriately, or the cost of serving the various types of customers, and it's a mechanism to develop pricing for wholesale customers as well. So in FY14, the commission went through this process, and we had 3 areas that we were looking to address. The first was water versus sewer revenue inequity. We need to adjust the rates accurately to reflect the cost of service. Fixed charge insufficiency, we implement a goal of trying to get to 25% of our revenue from fixed charges. And then it was noted that our rates are not reflective of a regional utility. We're looking to establish utility-wide rates over time. Then in FY18, we updated the cost of service, and the commission added another goal of mitigating bill impacts to low volume and average residential customers. So we've been mindful of that. Moving forward,
Mike, if I could interrupt one moment, if you could go back to that last slide, and kind of for the benefit of Charles, since he's rather new, could you explain to him that third item about the regional utility, what that
yes,
means?
Sir.
Thank you, because
yes, sir. So
I was about to ask.
So and I also want to mention that we will be updating the cost of service. We'll go through another cost of service study next fiscal year to update everything and realign, get the commission feedback based on the affordability study, the pandemic impacts, and take all of that into account with how we want to set our rates moving forward. But basically, we serve Forsyth County, and we have multiple jurisdictions: Clemens, Louisville, Walkertown, that have had different rates. We've got multiple interlocal agreements with those jurisdictions. We've had different rates and differentials put in place per the agreements that we instituted with those jurisdictions when we took over their service areas. And so looking at this holistically, we have a water treatment plant in Clemens. And historically, Clemens customers have paid more per the interlocal agreement. And so as our rate consultant, Raf Tellis, has come in and looked at all of this from a more holistic standpoint, we want to work towards working with those jurisdictions to try to come up with a more regional utility mindset. And that also goes outside of the county, where we do provide wholesale water to some of the surrounding counties as well. And so we do, as Lisa mentioned, we have an abundant water source, which the rating agencies are look upon favorably. But we also, we're in a position to be a regional provider of water service. And so there are multiple aspects of all that. And that was kind of a rambling off the cuff, sorry, Mr. Parker, perspective of that. But we can make sure that we hit on that part of the cost of service study component as we go through that next year.
Okay, Charles, does that make sense to you?
Yeah, I think so. It sounds like trying to impose some uniformity and consistency across the service area instead of this rate for Clemens, that rate in Louisville, and so on.
Okay, that was a lot more precise. Thank you.
Yes, that's exactly
what I was thinking. Thank you for pointing that out, Mr. Parker and Courtney. That was one. Okay, but it is true. So let's talk about the progress that we've made in regard to the cost of service study. The blue and sewer and orange. We've been trying to get to 53% of our revenue collected from sewer. Basically, we have a higher. The cost of service to provide sewer is higher than it is for water in our system. So we're trying to get the revenues to reflect that. So revenue from sewer was at 45% in FY14, and we're projecting it at about 40. I can't even actually see this. It's pretty bad.
48.
48%. Sorry. Thank you. Here in 21. So we'll also adjust those percentages. Those percentages will get adjusted likely as we go through the cost of service study next year. But we have made progress about 3.3%. 3.3% in the right direction there. Turning to the fixed charge insufficiency. So this graph shows our percentage of revenues collected from fixed charges, which are our readiness to serve charges, with water in blue and sewer in orange again, and the combined percentage in black, with our current goal of 25% shown on the far right. And so our combined fixed charges were at 12% in FY14, and then we're now at 19%. So we've made significant progress there since FY14, and are closing in on getting close to the 20% mark for combining those fixed charges. So that's another piece that we'll look at as part of the cost of service study next year. As we know that increasing the fixed charges more than the volumetric charges does impact our lower volume using customers. So any questions there? Okay, just looking at our consumption history, it's been, I would say, very consistent over the past 6 years, with FY20 being the lowest in some time, but not necessarily significantly lower. And we're tracking probably slightly ahead of the 6-year average through this part of FY21. So that's kind of what we looked at to help set the rates for FY22, and we did come up with 3 preliminary options for 22, and I'll run through each of those kind of separately here. Well, actually, let me address them here first, Courtney. Option 1 is no increase for either water or sewer. And then option 2 is to implement a 3.5% base and volume rate increase for both water and sewer. And then option 3 is to implement a 4.5% volume only rate increase on water and sewer rates. So diving a little more closely into. Oh.
Mike, this is Chris. If I could just interrupt on these options. And I don't know if this is a question for Damon or Lisa, but there are other items that people receive on their water bill, like stormwater charges. Do we know if stormwater charge is going to go up this year? Is there any change to that?
There's currently water fee budgeted.
I'm sorry. Go ahead, Heather.
Sorry, there is currently not a stormwater fee increase budgeted.
Okay, I appreciate that, because as we look at this, I think a lot of people, they look at their water bill in total and they have no idea when we start having separate items on that. So us not having an increase on stormwater is helpful. And I think that's the only other item that may impact that from there. And I know the thing is, as Mr. Griffin said, he's got some pretty sharp friends, but they still have questions about their water bills. So on that, I just wanted to ask that before we get into it. Thank you.
Okay, looking at option 1, which is no volumetric or readiness to serve increase, we did want to include this option, as we know that while the economy has rebounded from last year at this time, some of our customers continue to struggle with paying their bills. This option shows no change in the bills for any customer, and you can see that currently our light user has a bill just over $60 every 2 months, and our average customer is paying just over $100 every 2 months. Looking at option 2, which is the 3.5% volumetric and readiness to serve charge increase for both water and sewer. It increases the bi-monthly bill for the light user $2.15 and $3.56 for the average customer. And then the third option, which is a 4.5% volumetric charge increase for both water and sewer and no readiness to serve charge increase, does have a smaller impact on the light user. It's about 62 cents lower for the bi-monthly bill for those customers and 22 cents lower for the average household. And it is more expensive for customers with more consumption, as you can see here, such as the industrial customers shown on the right side here. So our rate recommendation for FY22 is option 2, which provides a revenue increase to bridge the gap as we continue to evaluate the financial impacts of the pandemic. It's got coverage for operations, debt service, and pay-go expenses for FY22, and provides stability and readiness to serve percentage as related to the volumetric charges. It also provides $123.7 million in total revenue and a projected debt coverage ratio of 1.96. And the next slide, Courtney, will show that our coverage ratio projection. We've got the slight dip below the 2.0 mark for FY22, but then we slowly rebound thereafter with an anticipated 5% revenue growth for FY23 through FY25. And just to note, that doesn't necessarily mean it would be a 5% rate increase. If we see consumption going up, that would help potentially offset a rate increase moving forward. So any questions about where we are with the rate recommendation for FY22?
This is Charles Wilson. I've got a question. If that increase to the rate via the volumetric is implemented, how would our rates compare to similar utilities?
Well, that's an excellent question. So,
okay.
So we've got this, and it shows our current water and sewer bills, our bill compared to our peers. And this is for FY21. And so we're currently the second lowest other than Greensboro. And that's, for both the fixed and volumetric components of the bill and the total bill. And so I'll also, those increases would keep us in that same position there, even if no one else raised their rates. But I'll let Courtney's had conversations with some of the directors around the state about their anticipated increases. So I'll let her touch on that.
Yeah, so I've reached out to our peer utilities that we are comparing ourselves to here and other utilities as well. But in general, it looks like, these are recommended rates to their boards that haven't necessarily been approved, but their recommendations fall in line with what we are recommending. The 3 to 5% rate increase is pretty much what I've seen the other utilities doing this budget year as well.
Thank you.
Courtney and Mike, if I could ask this question, as we look at this slide, is a 2-month bill an industry standard?
So I'll say that, meaning we are bi-monthly billing, you mean?
Right.
So I will say that our goal is to go to monthly bills once we get AMI in place, because people budget and AMI in place. Yeah, people budget monthly, so we feel like that will be, now's the time to do it if we're going to do it. You get the money in sooner rather than having to wait 60 days and it has a budget. So.
Okay, that was my next follow-up question on that, because whenever I talk to friends of mine, they get a water bill in and they're not even thinking. They just say, oh, well, this is how much I pay. And I said, well, that's what you pay over 2 months. So I think because they say, oh, I'm paying more in water than I'm paying in electricity. And I said, no, you're getting your electrical bill every month. You get your water every 2 months. People just get in that mode. So that will be one of the other potential benefits of AMI, as we progress forward with that. Okay, thank you.
Yeah, I have a quick add. So there's also an affordability advantage, obvious affordability advantage to the monthly bill, is it's half of what you would expect, as you just stated. So that's a step on the affordability ladder a rung you can climb. And the 2 months is really born out of the method that you use to read the meters. So manual reading is laborious and it's difficult and it's dependent on weather and all kinds of things, where more automated services are. And for some unknown reason, the water and sewer industry has always lagged behind those type of things. So when you saw, electric meters changed a long time ago, and then gas and other utilities. So is it common? It was very common before AMR to have, bi-monthly billing. As AMR came in, that's automated meter reading, which is drive-by, people started to go to monthly just to come in line with all the other utilities as described.
One other thing, I'll just so you'll just a little bit of FYI, we also are going to change to reading gallons versus cubic feet, because gallons is another thing that's more, people can relate to gallons versus cubic feet. So that's another kind of metric or measure that we're going to change as part of the AMI project.
Amen. You wouldn't believe how many people ask me about that. And I always give them a formula and they say, no, but I want to see it.
7.48, Hugh, you know that.
That's right.
Can we go back to the comparison of the three rates?
Right here, Mr. Griffin,
Well,
or even more, this one?
Yeah. Well, I guess I'm thinking about, we're coming off of the pandemic. A lot of people, we still got a lot of accounts that haven't paid, and a lot of them may not pay. And I'm wondering if instead of option 2, which would increase the base amount, what about I know this is throwing a monkey wrench out there, but I'm looking at maybe we have a small increase on the base amount to make sure that everybody pays a little something extra, but then put most of it on the volume. For example, like a 1% and a 4%, something like that. And that way, you guys are doing a uniform amount. Is there any way to change them separately and different?
Yeah, so to answer your question, we could look at a different combinations. There's endless amount of combinations that we can do. Both option 2 and option 3 give you the overall revenue increase that Lisa needs to meet kind of the financial model. My thought is, I guess our thought, staff's thought is we're recommending option 2 because there's such a small increase to the overall customer's bill between option 1 and 2 for our light users and average users. And then when we have to say, well, we have a 3.5 or a 4.5% increase, 3.5%, you don't get into the details about whether that's volume or base.
Right.
3.5 sounds better than 4.5, and it's just such a small difference between the two.
But if
also, I'd like to weigh in. Go ahead. I'm sorry. I thought you.
No, go ahead, Rand. I'm good.
Well, I do think the optics of 3.5 versus 4.5 are important, and also as someone that's been thinking about this, obviously I hate the word fixed charge. I like the word readiness to serve, but I'm presuming on that next chart we just couldn't fit in readiness to serve. But our folks are only paying $13 a month for the privilege of using this wonderful service of water and sewer. And I think it's important from the health of the organization to get the readiness to serve charge up to the recommended 25%. So anytime we mathematically do something that lowers the readiness to serve, we're going backwards in what we've been working on since 2014. And then the final point is, I think Courtney nailed it. If you look at the differences on the readiness to serve charge between options 2 and 3, it's pennies a month. I don't think people would notice it.
Okay. Well, I don't disagree. I'm just thinking about all those folks. But your point about the readiness to serve, trying to get it up to 25% is understandable. Yeah, because it's been a struggle to get there.
Especially, if you think about this, we have not had a volume increase in 2 years, I believe, and we had nothing last year. I think we just had a very small readiness to serve charge the year before that. So essentially, two years of no rate increases to come in with 3.5, feels pretty reasonable to me. But gleefully, I'm not a member of the finance committee, so I'm just here editorializing. Gleefully.
So, Randall,
hey, when my friends come to call me, I'm just the finance committee folks.
Push it off.
So having said that, and I'm just going to ask this for all the commissioners who are on the call, because we've gotten a suggestion from the staff about, option 2, a 3.5 base and volume rate increase. So how do y'all as commissioners feel about this recommendation? Maybe I'll start. Okay, Dwayne.
I'm comfortable with the option 2 as it is, some on each of those segments. Yeah.
Okay, Hugh, what about you?
Excuse me. Yes, I'm really good with that. I like it.
And Tom, you kind of spoke for a little while. I was sensing that you might be okay with the option 2, but maybe go ahead and tell me.
Oh yeah, I'm fine. I just, was throwing out something to talk about.
Okay, and Charles, do you have any thoughts or questions?
Option 2 seems reasonable to me, 3.5. Not being on the finance committee, but for what it's worth.
Well, you'll ultimately vote for this, right. So I just want to get your take.
What do you think?
Yeah, I had kind of thought about it, and I looked at the optics. And as Tom, as you and I've discussed with others, sometimes our bill can be confusing, and trying to explain people the difference between 4.5 on volumetric and nothing on readiness to serve versus just 3.5 straight. People aren't even going to realize that it's basically the same within pennies. They're just going to hear 4.5 and 3.5, and I think the 3.5 just sounds more palatable than 4.5, which I think Randall had kind of made that point as well.
Well, do you need a motion?
Are we going to take this individually between this, or let me ask these parliamentary rules here. Are we going to vote on these rate recommendations, or are we going to wait until we get to Jan's presentation? Do we want to do that separately?
I think you can do it either way. I think you can vote on something now, or we can wait to the end and you can just say, that you recommend approval moving forward with how we've presented it, and combine the two.
Okay, well, if we can go ahead while it's fresh in people's minds, because they may be so excited with what Jan tells them, they forget about all this stuff Mike's been talking about. So do we have a motion to approve or recommend to the overall commission option 2?
So moved.
I'm sorry.
Second?
That's Hugh Jernigan. So moved.
Oh, okay.
Okay, and there's only 3 of us, so let's see. Patrice, do we need to do a roll call vote on that?
We don't need to do a roll call for the rest of the commission. Courtney, do we? No.
Okay.
No, you just need to take a vote.
On the finance committee, am I correct?
Yes, the finance committee, that's correct.
And so the roll call on that, Hugh?
Yes.
Option 2?
Yes.
Tom? Option 2?
Yes.
And myself, option 2, yes. Okay, so that'll be what we'll push forward to recommend to the entire commission.
Right.
Okay, Mike, is there anything else you need to tell us about water and wastewater?
I don't think so. I have a lot more. I've had some time to think more about the regional utility piece of things. If anyone would like to hear me talk more about that. No, sorry.
Is it real concise?
If you would. No, it's not. If you would maybe move to show the next slide real quick. Because we do, obviously, we'll be bringing you the commission. We'll be bringing the full commission the items. I think it's the slide right before this, Courtney, for both water, wastewater, and solid waste at your meeting in May. May 10th. And then I did just want to reiterate the fact that Raftellus will be coming back to do the cost of service study again next year. So, and we are looking forward to engaging with you all in that dialogue to make sure that we're going down the right road for the next 4 years.
Is that the last time it's been done?
It was in 18, FY18. So so it'll be, this one will be in 22. We try to do it every 4 years.
Okay. Well, thank you, Mike.
Thank you all.
Okay,
I'll turn it over to Jan.
Thank you. Good afternoon, everyone. It's good to see everybody on this beautiful day. We'll dive right into the solid waste budget, and we'll follow pretty much the same format that we did with water and sewer. So feel free to ask any questions at any time. I'll try to pause at least a few times throughout. So the solid waste budget request, we'll start with expenditures, and they are budgeted at $11,844,350 for FY22, which is a 2.4% increase over the previous year. We'll talk a little bit about each one of these categories, but supplies and services is the biggest part at $6.3 million. Personnel is budgeted at $2.65 million. Debt service, 1.87, and the countywide recycling programs are budgeted at $999,000, just underneath $1 million. Starting with personnel, budgeted at $2.65 million, which is a 5.5% increase over the previous year, which is FY21, the current year. And this is largely driven by increases in the salaries, full-time salaries, and the addition of one heavy equipment operator. This is needed to address the increasing workload at Haynes Mill Road Landfill. And there's also a 2% merit-based pay increase included in that increase for salaries. Overtime, we're also seeing an increase in the need for overtime to address this increasing workload during the pandemic. We're requesting a $16,000 or 10% increase in overtime budget. And benefits, we're seeing an increase in the retirement system and I believe unemployment insurance. So there's a 4.3% increase there. Supplies and services, this makes up the largest component of the budget. It's budgeted at $7,322,460, which is just over a 3% increase. A lot of this, or perhaps I think most of this, is in contracted services. And in this category, we include yard waste processing, scrap tire processing, and engineering consulting. And I believe of those three, the yard waste is by far the largest increase because we're seeing more waste coming into the system. Temporary labor, contracted labor, that is we're also seeing increases in the need there, similar to what we mentioned about the operators and overtime pay. We're seeing a lot more customer trips at Haynes Landfill, and we're also increasing the rates that are paid for this contract labor as the minimum wage for the city goes to $15 an hour. The closure, post-closure accruals, this is the money that we set aside to close the landfill and to take care of it post-closure. That's increasing 3.7%. And interdepartmental charges from other city departments increasing almost 1%. Some of these have increased and some decreased, but the net increase is about a 1% increase there. Contracted equipment maintenance to repair and maintain our heavy equipment is increasing about 2%, just basically per the contract's CPI increases there. And there's a couple of items here that we're decreasing: the household hazardous waste and electronics recycling contract, and some miscellaneous items, streets department and utilities are decreasing some.
Jan, this is Chris. If you could stay on that slide. As you mentioned the temp labor, or go back to the previous slide, as you mentioned, the temp labor, so what you were saying is since the city has instituted a minimum wage of $15, that also impacts whatever contract labor that we get as well?
Yes, that's correct. Most of the temporary labor is at the lowest pay rate. It's a laborer class of worker, and they will make the $15 per hour that the lowest paid people in the city make.
So is there a compression in the wage structure based on that, or is there a ripple effect?
There's not a compression issue as it relates to supervision. I think all our supervisors' pay is higher than that, but we do have some people making very close to that amount that are in other jobs. So it brings the pay grades much closer together. That's true.
Okay, thank you.
Hey, Jan, I've got a couple quick questions. Regarding personnel, how many vacancies do you have, position vacancies?
Right now, I think we have 6.
Okay.
And 2 of those would be in professional level, administrative roles, and the rest in operations.
Okay, and I was curious as to whether the overtime was because of the vacancies.
Absolutely, yes. We've seen increased workload and more absences and vacancies over the last year.
Okay, thank you very much.
And Dwayne, if you were to ask Mike, he may give you an even larger number of vacancies on the water and wastewater side.
I didn't even think about it when Mike was up there, but I assume you do have significant openings there.
We've got 45.
Wow.
What is normal in a normal year, a non-COVID year?
Well, I think we've seen it about 5 years ago. It was that high, and then we had dropped down into the probably. I think the lowest we got was around 32. So we've been kind of steadily climbing back up. So yeah, it's about 13%. I think it's in the 13% range, and the majority, I think 33 of them are at field operations.
And those tend to be the $15 an hour entry levels, Mike?
Correct. And yes.
And I would say a lot of them may not be, the first level, but they're equipment operators, and we're just having a hard time finding equipment operators and then keeping them as well, because they'll find other jobs. So that's been a challenge.
And Jan, the temporary.
Go ahead, Dwayne.
Jan, the temporary labor that you're getting at the staffing agencies, I presume, are they any good? Are they good staff or not?
Yes, generally speaking, of course, maybe not 100%, but yes, the city has a contract with Winston Personnel Group. So there's a blanket purchase order for the entire city to use. And we just have to call and say, we need a certain number on any given day. And yes, we get some very good people.
Excellent, thank you.
So with these positions that we're having such a hard time with on the lower end of the scale, especially that require a certain amount of skill, a heavy machine operator, how well does that fit into the classifications that the city has that we have to fit into their wage structure? Are we able to maybe move them to some type of different classification that allows to pay more?
Well, we have had conversations with, we have a newly hired HR director who's been with us, I don't know, probably less than 6 months. But we have had conversations with him, and we are looking at our equipment operators and how they fall in line with the city's pay plan, and do we need to make adjustments, and where there are areas that we need to make adjustments. We're working together to do that.
I would add too that I think the pay scale for operators in the city, whether it's our department or others, is slightly below what the private sector pays for, especially for heavy equipment operators. So we do lose a lot of people to the construction sector. Or we can't attract them in the first place in some cases. So it is a challenge for us. Anything else on that? Okay, this chart shows you, similar to what we saw with water and sewer, it shows you 6 years of actual expenditures for supplies and services, and then a projection for the current fiscal year that we're in, FY21. So it's been a fairly steady increase over this period, except for FY20, which was kind of an anomaly because of the final quarter, the last quarter being affected by the pandemic. So the recycling programs that are funded through the solid waste budget are separated out here. That $1 million, or the $999,000, was included in the $7.3 million that we saw in the previous slide. But because they're funded differently, we thought we'd show you these totals separately. Overall, there's a net decrease of 0.85%. On the drop-off and schools recycling side, those are the programs that are funded by the county. We're seeing an increase there of about $18,000 for those two put together. And they are fully funded by Forsyth County per our interlocal agreement. The household hazardous waste contract, that's 3RC, the Enviro Station, we're seeing a decrease in those costs of 1.9%. So that's why you saw the decrease in the transfer from the water and sewer funds to fund that program. On electronics recycling, we're also seeing a decrease in those costs. And that is the only program on this slide that is paid for out of the solid waste fund. Moving on to debt service, it's budgeted at $1.867 million, which is a decrease of just over 4%. On the equipment replacement side, we just had an extended discussion about NCMLC, so I won't go into that in detail. But it's budgeted just over $1 million, which is a 7% decrease compared to last year's budget. And the debt service on our outstanding bonds is budgeted at $824,350, which is roughly the same as it was last year. Slight decrease there.
Jan, are these vehicles replacements, or is any piece a new piece?
They are all replacements. I think the very next slide gives you a little bit more information about each one. Since we only have 3 this year, we went ahead and called out the details on those. The SUV that you see at the top was deferred from last year. That was scheduled to be replaced last year, and we deferred that in light of the pandemic. The Tarp-O-Matic is the automated tarp applicator that we use at Haynes Landfill. And the articulated dump truck that's shown there is for Old Salisbury Road landfill.
All right, you had a new equipment operator that you wanted to put in the budget. What is that individual going to operate?
One of the largest needs that we have right now is to drive the roll-off trucks from the convenience area, which has gotten extremely busy over the last year, to the working face at the back of the landfill. So those two positions are actually classified slightly differently. They're classified as medium operators, but we're having to use heavies to fill in for that and to keep all 3 trucks running. So they'll certainly need to drive a roll-off truck. And then in addition to that, the compactors and the dozers, the excavator and the dump trucks.
So you're gonna hire a heavy is what you're gonna hire? Yes. Okay.
That gives us more flexibility. If we hire a heavy, they could operate all of those pieces.
To one of Tom's questions earlier along, so these 3 items are all the ones under the North Carolina municipal leasing.
Right.
And the SUV, would that be the only one among the 3 that was a group purchase? Is that a potential group purchase? Because obviously no one else in the city's found a Tarp-O-Matic.
Correct. Yeah, definitely the other 2 are unique to us. All the off-road equipment is only used in solid waste. Whether the city purchases SUVs in large lots or not, I'm not sure. Heather may know that.
Police department uses a lot of them.
That's true. we do need four-wheel drive. So as long as another department had similar specifications, there would definitely be an advantage to.
Fleet handles that. I don't know if that's Heather, but all the request comes in for the budget that year. So our department, as well as other departments, they would pull all those together and bid those out or go through the purchasing process. It's what works best.
Yeah, I was just going to echo what Courtney said.
Was that helpful?
Yes.
Okay, good. This is a summary of all the categories that we've just discussed. So you see the total request is $11,844,350, the 2.4% increase over the previous year's budget. So it's a good time. If there are any other questions before we go to revenues, we'd be happy to talk about those. So revenues are budgeted at $13,211,600, which is about a 3% decrease over the current year's budget. This is largely driven by a decrease in tonnage coming into Haynes landfill and Old Salisbury landfill. As I mentioned, we are seeing yard waste increase, but the majority of the waste tipping fees come from the landfills. So they're decreasing about 3.4% based on these projections. Intergovernmental revenue is money we get from the state of North Carolina to fund the scrap tire recycling and the proceeds from the solid waste disposal tax. So we're seeing that trend downward a little bit based on past history as well. So be conservative there, we're decreasing that budget by 6.4%. Resource recovery is the revenue from the sale of landfill gas and the scrap metal that we recycle at the landfill. And we are seeing an increase there largely because of the commodity revenues for scrap metal increasing. And the transfers in are the monies from the water sewer fund and the county to pay for those programs. So the revenues that you just saw do not include an increase in the rates that we're charging our customers. We're not recommending or seeing the need to increase the fees for FY22. So we went ahead and left them the same for the upcoming year. With the rate, just as a reminder, the rates are listed there. They range from $32 per ton at the yard waste facilities, and for the discount rate at Haynes to $34 for the gate rate for the other customers. So we do update a cost of service study each year to analyze the full cost of delivering our services. And you can go to the next slide if you don't mind, Courtney. We won't go into a lot of detail about this, but I wanted to at least show you the summary of the full service cost for FY20. The study does calculate the full cost of providing each service, not just operating, but indirects, capital costs, debt service, and everything is allocated across the 11 cost centers that you see listed there. So if you look at the bottom right corner of the table, the aggregate cost or the overall cost is $30.21. So it gives you an indication that when your waste is coming into the system at $32 to $34 per ton, it's an indication that we're covering the cost of delivering those services. It is a little bit more complicated than that, and we have a cash flow projection similar to what you saw on the water and sewer side that we're in the process now of updating with Lisa and her staff. So we'll be bringing you that in the near future to give you a little bit more information about the life cycle cost of operating the landfill. And lastly, we wanted to just show you a little bit about solid waste disposal rates on a regional basis. So we're showing 5 publicly owned landfills in the central part of North Carolina and 2 transfer stations for Durham and Greensboro, where they've chosen to close their landfills and they transfer their waste out to a remote facility. So Davidson County, City of High Point, Wake County, Rowan County, and our facilities are listed there. And generally speaking, we're in the lower end end of that range. Other than the C&D landfill that we operate, the tipping fees are lower than everyone except for Wake County.
Jan, do you know what the rate is down at Troy, at that private facility?
You know, that's a Republic Services landfill, and they probably do have a posted gate rate. I'm not sure what it is offhand, but many of their contracts are internal because they're a hauling company and a disposal company. It's very hard to know what their actual costs are.
Well, at one time, I thought there was right much waste from Forsyth County going down there. I thought we talked about it at some point.
Absolutely, and I should mention that because that's another driver in making a recommendation not to increase rates at this time, because we have seen, I don't remember the percentage offhand, but a pretty large increase in the amount of waste that's being transferred out, both to that landfill in Troy, Uwharrie is called, and to Great Oak, which is a waste management facility in Randolph County.
Right.
So we're seeing a lot of waste leaving the county, and I think it was around 120,000 tons of municipal solid waste that went out of Forsyth County through the transfer station on Overdale Road.
Yeah, so unlike water and wastewater, you have competition.
Yeah.
This is true. Yes.
Jan, just curious, do you know what the tonnage rate is for Charlotte, just off the top of your head?
For the Charlotte Motor Speedway landfill?
Well, any of it, Charlotte Metro.
Oh, interesting. I could get that for you.
Just curious. Yeah.
Charlotte and Mecklenburg transfer their municipal solid waste to the Charlotte Motor Speedway landfill in Cabarrus County. So their landfill is used primarily for C&D. The one that the county has, that Mecklenburg County has, is primarily a construction and demolition landfill.
Yeah, that's okay. Yeah, just curious if you knew.
Well, it's hard to get our gate rate at Piedmont, or not Piedmont, Uwharrie landfill, because it just runs all over the place. It goes, I think it goes from 46 down. But it's according to who you are and what you take.
Okay.
Because the high volume people like City of Greensboro don't pay near as much as you and I would if we took something in.
Okay.
Absolutely. They negotiate rates and offer RFPs and that type of thing.
And I thought the Charlotte, the transfer facility stuff there, I was thinking that was 46 maybe. I don't know. I think I saw that one time.
That would be consistent with a lot of cost to transfer and dispose.
So do we have any other questions for Jan?
Thank you.
Okay, Jan, great job. And I felt like we should have a drum roll right before you brought up that you were going to have no suggested rate increases on there. But we do have a finance committee right now that has 3 people in it, of which Hugh and Tom are. So unless they want to make a recommendation that we increase the rates, despite what Jan has recommended, do we have any other questions or discussions on this? So do we have a motion from a member of the Finance Committee to make a recommendation to the overall commission to adopt no rate increases for solid waste this year?
Ms. Hugh Jernigan, so moved.
Do we have a second?
Sure.
Okay, so Patrice, can we take a, and let me go ahead and ask for the rest of the commissioners who are here. Do you have are you in agreement with that, Dwayne?
Yes.
Dwayne, Charles?
I am also.
Okay, Randall, any thoughts on it? These thumbs up. And I don't think I missed anybody. Okay, Patrice, if you want to go ahead and take a vote on that motion then.
Okay, Chairman Chris Parker.
Yes.
Commissioner Tom Griffin.
Yes.
And Commissioner Hugh Jernigan.
Yes.
Okay, thank you.
Okay. So, Courtney, before I make some concluding remarks, do you have anything you want to wrap up with?
No, I guess, the plan will be, this will be on the May agenda item for recommendation for approval to the City Council, part of our normal process. And then it'll be on the City Council's agenda in June with the remaining other city departments' budget. So that's kind of the next step for us.
Okay. Do we have any other commission members that want to say anything, add anything? Okay. Well, what I'd like to do is to say thank y'all all. I know it's been trying in yet another budget year to put these things together. And as I look at everybody's faces, I don't know how y'all are able to do all this through Zoom. But I guess you do have to get together at some point, and maybe by the time we get together again, y'all will actually be in your office space that we are paying so much money to Damon to be able to use these new digs. So I just want to appreciate all the hard work that y'all have had in doing that. One question I do have for Courtney, though, is did I miss an article in the newspaper about that great news of our #2 ranking in the country?
Exactly.
Yeah, I think it made WXII had it. I don't know if it's paper or social media today. So I've been getting a lot of text about it. And Spectrum News wants to do an interview on Friday. So.
Okay, but we will get it to see it in the Winston-Salem Journal.
I would. I'm assuming the Journal picked it up. The news release went out last Friday, and so I guess the Journal picked it up. I'm not 100%. Does anybody else know if it made the Journal or not?
I've not seen it.
I just have not seen it. And the beautiful, I guess maybe the river otter was a lot cuter than clean water. I don't know, but the river otter got a lot of good coverage. So anyway, Gail might want to just follow up with the Winston-Salem Journal on that, because this is great news that I've been sharing with the people in this community. And to give them bragging rights, because I've been taunting friends out in Texas and other parts of the country about how good our water supply is here. And then they say, what about Colorado? I said, I can't speak to that. But if I could also, I don't know if this is, but there may be some seriousness in this, and there may be a little humor, but as we look at promoting, what a good utilities we are, both financially and even more so with our wonderful water that we are producing, I think maybe Gail should do a little bit of research and see about some of the breweries and maybe how we rank for beer water. Something like that. That would be a really cool thing for us to have some bragging rights against Asheville on. This has been a weekend in Asheville. So anyway, I'll just kind of throw that out there. But okay, if we don't have anything else to add, can I have a motion to adjourn our Finance Committee meeting?
I guess I will if nobody else does.
Okay, and Tom is in agreement on that because I saw him giggle. I don't know, Patrice, do we need to take a vote or can you just...
I think we're good.
We're good, okay.
I think we're good. Thank you, guys. Have a good afternoon.
Okay, thank y'all all for your time and we'll see you next.
Thanks, everybody.
See you soon.
Thank you.
Thank you.